So that's a big question, I think, that everyone has in mind. I would say because of our specific focus on China in particular, we've already filtered out a lot of the conversations where I think international GPs are not willing, for whatever reason, to look at China at this point in time. But I would say on the remaining conversations that we are having, if we split, I would say the difficulty levels, right? If we're looking at fundraising, we're looking at deployment, so investment strategy, we're looking at exits. I would say probably number one difficulty is on exits, which has its implication on fundraising. So those are the two key hurdles, I think, for GPs at this point in time in our conversations with LPs. On the deployment side, I think things are actually looking more comfortable after reopening 3 years of zero COVID, mostly because asset prices have become more reasonable. Secondly, I think there was a good filtering that went through when it comes to entrepreneurs themselves. So definitely people on the ground nowadays think over twice at least before launching. Compared to 3, 4 years ago, I think there's quality of the assets are also higher. So on the deployment, we're actually pretty much confident, much more confident than in the bubblish valuations of 2020 and 2021. So hopefully the way the market is going to work is, for the selective managers who still have dry powder in the market, will be able to deliver in this difficult environment. And as geopolitical risk hopefully do not worsen too much from here, people will be willing to look at China again on fundamental levels from a bottom up, looking at the right assets. And with a few significant milestone IPOs up and coming over the next 12, 18 months, we would love to see some more traction coming back from the global LP crowd. Great question. I think we discussed about this on the panel a little bit yesterday as well, sort of China versus the rest of emerging Asia, let's call it that way. I think at the end of the day, right now, for global LPs, it's really a matter of getting allocation sort of strategy reset, right? And talking about alternatives and particularly private equity or VC in particular, I think people would need to figure out how within that portfolio they would want to allocate geographically speaking, right? So the traditional sort of developed markets in US, Europe, Korea, Japan, and North Asia, and then emerging crowd, right? And how that emerging allocation basket gets divided on a few large, geographies and countries. I think China would always remain there. Now, of course, we've been hearing a lot about, money coming out of China, going into India, going into Southeast Asia. I think that is an objective assessment over the past 2 to 3 years because people are looking to diversify. But again, I think for China in particular, the question is more about understanding and being willing to accept China as a new normal, because China delivered very well in general over the past 15 years that dollar venture capitalists have been present in the market. I think, a lot of GPs, a lot of LPs behind these GPs have made significant returns. So there was always a, tag upon China, sort of high beta return for the same sort of unit volatility risk implied. So I think people need to adjust that sort of what would have been the normal of the past 15 years. Going forward, that is going to change. It is going to change because average sort of beta would not be as much as what China has delivered in the past. You can see all those numbers through macro indicators, whether it's GDP growth, whether it's retail sales. But at the end of the day, I think for private managers, and especially for relatively early stage VC managers, the investment philosophy has been always about bottom up cherry picking, stock picking. It has always been about, not that much about the averages and the aggregates, but about alpha on the ground. So I think that's a new investment sort of landscape that we're coming into for China in particular. And versus other countries, India, Southeast Asia, where you still have a little bit of, beta oriented, I think, bets that are going in. So at the end of the day, I think these are different geographies. These are different economies. These are different timeframes when it comes to investment, when it comes to investment strategies. So I would not go in China versus emerging Asia. I think it's a matter of allocating. It's a matter of diversification. And within that diversification, China would continue and always have its place, in my opinion. So, like I just mentioned, I think overall it would be hard going forward on your expectations on China's strategy to have the same sort of returns across industries, right? So industry pick, what we call verticals pick in-house, is going to be a key significant driver for returns going forward. So the way we see it is, first of all, you have to look at the right sectors. And then within these right sectors, you have to bet on the right companies, right? So there's a twofold strategy there. Um, which sectors in particular? I think there will continuously be sort of tech, deep on the ground, tech enabled or tech driven change factors, what we call delta factors, that would be able to drive some sort of category beta, high beta return. In China in particular, over the past 3 years, I think these have been concentrated partially on deep tech, mostly on energy transition verticals. We're looking at green tech. We're looking at people have been mesmerized by what China EV is offering to the world and how dominant China has become in the global supply chain, whether it's batteries or whether it's on solar panel across the entire value chain of the industry. So these, I think, are cyclical industries where you would be able, if you get the timing right, the entries right, the bets right, to have a relatively short-term upside. Looking medium to long-term perspective, I think consumer industries in particular, which is our focus. So I'm a bit biased in that opinion. We're so very comfortable because at the end of the day, if you believe in what China has already done over the past 30, 40 years, if you believe that whatever has been done in terms of, becoming the China in 2020, 2023 is not going to go away in, a short period of time, then consumer would always be there. And we would say that despite the fact that people have not seen the sort of rebound that they were expecting post zero COVID, and if you look at consumer numbers, a lot of these aggregate average numbers have not been up to the level of where people were expecting them to be. We're continuously seeing opportunities because consumer is typically an industry where you will have to delve much deeper than the average number, look at different categories, look at what are the opportunities in categories that are suffering from less consumer spending. And there are opportunities there. We don't have to look very far. Japan, our neighbor, has provided a lot of guidelines, from 1990 to 2020 onwards, 30 years, where a lot of consumer companies have made it to very significant size. And on the other side, I do believe, given the size of the country, that there are still a lot of structurally growing sectors within consumer categories where you can bank on double-digit growth from levels that were not high prior. These are typically new category opportunities, spin off from large verticals. And within these sectors, we'll continue to see high growth profile companies over the next upcoming 3 to 5 years.